the pharma sector, but what is going on with the bond markets? Who better than Lakshmi Iyer, CEO at Kotak Alternate Asset Managers, joining in on the show to dissect that and where it's headed next. Lakshmi, great to have you today on ET Now. Thanks for your time. Lakshmi, the yield spreads, between India and the US is now as low as just about 175 basis points. And I think it's the lowest in the history that one has seen of bond spreads. How do you read this and what is the market telling you?
Absolutely. Good morning, Aisha. So, before I jump straight to the markets, I'm a big fan of McDonald's. And, when McDonald's came into India back in the late 90s, the price of a McBurger versus a Vada Pav, the gap was over 8x to 9x. And circa today, the gap has shrunk to maybe 5x or maybe 6x. That clearly, if I take that analogy and take it to the bond markets, whether it's US bonds versus Indian bonds, it's a very similar kind of trend that we are seeing. The worst spreads that we saw was north of 7%, and today we are at well under 2%, the absolute lowest that we've seen in the last 20 years. Demand supply, the massive debt that is prevalent in the US, and obviously no real impetus even right now to cut interest rates. Completely different dynamics happening in India, Aisha. Demand is reasonably favorable, especially domestic demand. Inflation is very well under control. And of course, the rate cycle easing has just started. So I think, yeah, all of these factors clearly are favoring Indian bonds at the current juncture.
Good morning, Lakshmi. Always nice to have you on the show. This entire uptick in bond historically has led to outflows by foreign institutional investors. But this time the dollar is not strengthening along with the uptick in yields. Why is that? And what does that mean for flows?
So very valid point and very valid observation, Nikud. So two things happening. Will the flows probably peter out or kind of flat out a bit, especially with foreign institutional investors? When they look at Indian bonds, they look at it covered for the currency in the forward market. Now, if you do that, the numbers, the net dollar return to the foreign investor in Indian bonds is lower than the holding of the US Treasury. So definitely we could see some slowing down. We've already seen net flows negative in the month of May. Now, on to the second point, why is the dollar not strengthening? So two parts to it. You look at the US debt at north of $36 trillion. The incremental auctions in the US are also meeting with very tepid response. So this is some way of markets to signal to the policymakers that the faith incrementally, if it needs to be restored, something needs to be done about the burgeoning debt. So I think that dynamics is at play. So there are multiple moving parts to the jigsaw puzzle right now. And as you go along the next few months, I think this is going to unravel in its holistic sense. Till then, this volatility is going to be the order of the day.
Lakshmi, the last time when we saw yields between India and US narrow to 250 basis points was in 2006 or 7. It was also the time when you saw US yields as high as 4.5%, which was before COVID. Given the uncertainty around with how, this post 90-day tariff reprieve period is actually going to play out and how, all the dynamics in the world are going to be panning out, tell me, do you see any major risk globally?
So, Aisha, the biggest risk at the current juncture, as I said, is twofold. One is definitely what is emanating from the US and the Trump tariff-related uncertainty. But even bigger thing globally, which is unfolding, is the massive jump in Japanese bond yields. The 30-year and 40-year bonds have stepped up or bumped up so high that the central bankers will have to step in to support the bond markets there. Even in Japan, if you look at the debt to GDP ratio, it is north of 250%, which means Japan cannot afford such a massive debt burden. If the yields go up, they will not be able to service that. And productivity obviously is an issue. So they will have to print more currency. That is the bigger risk, unfolding. And that clearly worries me. If you look at the Japanese auction, you've never seen this kind of a tepid response ever. And mind you, Japanese inflation, which is CPI, is ruling at 3.6%, which is significantly higher than India's inflation, which is looking to edge towards 3%. So I think from a market standpoint, that is definitely a bigger lurking worry. Do we have an answer right now? Probably not. But I think the unfolding dynamics in the Japanese bond markets and the yen is going to be something which we will keenly watch out for.
So, Lakshmi, at what point in time markets would start panicking about the US 10-year movement? Could it be 5? Could it be 5.5? What is that pain of threshold for the 10-year now?
Well, I'd say, Nikunj, another 30, 40 basis points closer to the 5%. It's a more psychological number. In the near term, markets are kind of taking it in the stride and not getting overtly disturbed about it. But yes, if these yields bump up beyond 5% and nothing really happens beyond that, because mind you, every country which is holding US treasuries, larger ones, are actually net sellers. And similar is the case with Japan, where 44% of their own government bonds are held by Japanese government themselves. So I think these are going to be, the trigger points. So up to 5-10 basis points, I don't think markets will be disturbed, but a 5% threshold breaching and sustaining will definitely be worrisome, which will call for some profit booking in Indian bond markets as well.
I can split the construct into two for US economy. Tariff, low growth, short supply means higher inflation. Yields will go higher. I can come with another construct, which is that a tax cut and surprise resilience in the US economy means consumer demand will come back. That could also lead to yield, real uptick. So what will take yields higher? Could it be inflation or could it be consumption?
I'd say more of inflation because clearly, the consumption doesn't seem to be coming back in a significant hurry right now. And even if that picks up, as you rightly observed, that will stoke inflation further. However, one cannot completely ignore the housing market, Nikunj, in the US, which is clearly showing you the kind of unsold inventory and the kind of price cuts that the US, house builders are doing over there. And that is clearly pointing to a slightly more sluggish economic growth. So clearly there is a case there which is caught between devil and deep sea, which will prevent any significantly abrupt movements, north of 5%. And if it has to sustain there, then it has to be very, very strong inflationary triggers, which we don't really see at this point in time. And secondly, as I mentioned to you, and you observed, that when the yields in dollar terms become less accretive or lucrative for the foreign investor, he or she will actually look up to the pole star in this case, which is the US clearly.
Now, for our audience, before we wrap, what matters is that what will happen to flows. I go back to that same point again, which I started with the first question. So, can I say that in the near term, as long as dollar remains weak or the dollar index remains weak, the concerns about outflows by institutional investors or by FIIs, as we say, FIIs, it will not come back?
Well, the concerns are real, but if you look at a combination of debt plus equity flows, we should still be able to hold forth, Nikunj, and therefore I am not overtly worried, going to get excessively paranoid about a rout or a carnage on the rupee front, and that is from an investor standpoint. But clearly, if you look at just the last year, calendar 2024, 1,35,000 crores odd of net sales positive in Indian fixed income, that probably may not repeat in the year 2025.
All right, Lakshmi, I really appreciate your time. Thank you so very much for joining us on ET Now. Let's take a break.